All right, I want to share a theme that you can use across multiple industries as a way to make money in the stock market. And first, I'm going to just talk about types of competition in a marketplace. And if you think back to your Economics 101, everybody remembers perfect competition, right? This is a hypothetical industry with a ton of different competitors, undifferentiated product, and all the competitors basically are beating each other up to get market share, to get sales, and nobody makes any money, basically. It's an unprofitable industry because there's too many players. And you can think about maybe the auto industry in its early days when there are dozens and dozens of different auto companies and basically nobody really made any sustainable profits. Then on the other extreme, you would have a monopoly. So there's just one player, right? And when you have a monopolist, usually that company extracts major profitability at the expense of the customer because they get to decide what the price is and they get to decide or what the price of the product is or what the price of the service is. So today, in the modern era, we have regulatory bodies that prevent most industries from consolidating down to a monopoly. And if a company manages to gain market share and become a monopoly player, in general, our Federal Trade Commission or the Justice Department will actually often break up a company when that happens. So we saw that with Standard Oil in the turn of the century, 1900s. We saw this with AT&T. It was forced to break up because it got too big on its own, and it was forced to break up into the Bell companies. So what you want to find, though, is there is a sweet spot where monopolies are in general not allowed. Of course, there's exceptions. And perfect competition that's anathema to stock market investors because nobody makes any money. So what the Justice Department and the FTC the Federal Trade Commission tends to permit is consolidation down to a point. And that point tends to be 5 or 6 or 4 players. Not too few, like 3 or 2. But if you can have 4 or 5 players in an industry, that's competitive. But it's what you would consider an oligopoly or oligopolistic competition. This is what you want to look for. And if you can find an industry that is trending down to oligopoly, that is an industry that is going to start to show better and better profitability in the coming years once oligopoly is reached. So I'll give a quick example. The industrial gases industry. It's an industry that nobody's ever heard of. I mean, you might have seen like a Praxair tanker driving down the highway, a truck with like liquid nitrogen in it or something, or Air Products, that's one of the other companies in this sector. This industry had about 10 players about 15, 20 years ago, and it started to consolidate. And I remember I was still working in the business back then. I was a buy-side analyst for a large insurance company that will remain unnamed. And I saw this company go from 5 players to 4. And the thing is, when an industry consolidates to oligopoly, it has the appearance of competition, but it doesn't really have competition. Because there's so few players that everybody knows everybody. Everybody can see the prices that other people are charging or bidding when they're looking for new contracts. And people start to behave because they know that if one company starts to bomb pricing and gather too much market share, the other companies in the industry will respond and also bomb pricing, and nobody wants that. So you tend to get kind of good behavior. You might have one company that's sort of the price leader, and it maybe will bid a certain price level, signal a certain price level. Remember, these companies are not allowed to discuss pricing together. That's illegal, but they can see the kinds of bids that are out there in the marketplace. Or if you think about the consumer products industry, you can go to a grocery store and see what the retail price is for a box of Oreos or whatever. So, companies are going to see the price leader, see its actions. They'll generally follow. So if a price hike happens, the rest of the players will follow. And so you get this sort of benevolent kind of co-opetition or like a pseudo-collaboration among the companies. It's not overt, but it still happens. And so when you see an industry that's an oligopoly, and if you can find, say, the best company of that industry or the company that's the price leader or has the lowest cost structure, that industry is a good place to put capital, and that leading company probably is a good place to put capital too, because the industry is going from more and more competitive to less and less competitive, and this cycle can last a long, long time. So, for example, Air Products was the company that I had our firm invest in back in the day, and it's been a spectacular stock even through the credit crisis. Very, very good stock, and its economics improved meaningfully once the industry got down to oligopolistic competition. So it doesn't have to be in industrial gases. You can see this in definitely in all kinds of different industries. You start to see the number of players sort of reduce. When you get down to, say, 5 or 6 players, and maybe 5 years ago you were at 8 or 9 players or more, that's a good time to invest because the economics are probably going to improve. So keep that theme in mind. As always, thank you for watching, and I hope these videos are helpful.